for being here with you today. It's a pleasure, and I hope next time I'm going to be as well in person. I really enjoyed last time I visited Exeter. This is not my job market paper. It's my second year paper that I've been working for some time, but it's now ready. So I'll be very glad to receive your feedback and answer your questions. It is about a novel third-party reporting policy in Greece, and about income tax incentives to encourage electronic payments and a shift from cash to electronic payments. And I provide evidence of taxpayers' responses in these incentives. So let me quickly set the background of what this policy touches upon. As you might know, the VAT has an element of self-enforcement, namely that when businesses transact between them, they have an incentive to ask for transaction receipts because these are tax exempt. They can deduct them as inputs to production. And so it has been widely researched and shown that the VAT in business-to-business transaction has a strong self-enforcement element. The seminal paper for this was Pomerantz 2015 on an experiment in Chile. But the self-enforcement element of VAT breaks down when we come to the final consumer. In retail transactions, final consumers don't have an incentive to ask for a receipt because, of course, it's not tax deductible for them. And so this has been called the last mile problem in VAT taxation, where most of the VAT gap exists. Most of the tax evasion in this type of consumption tax exists. And so governments since the 1950s or so have been very creative in ways to create value in this final receipt that is that needs to be asked from the customer to the firm in order for the transaction to be recorded, and so the VAT receipt to be printed and the VAT, the 20%, 25%, whatever the rate is, to go to the government. The most usual ways that this has happened is through tax lotteries, and there have been other inventive ways, such as tax rebates if you pay by card and so on. The prime example in this is Naritomi 2019, which examines the Brazilian tax lottery and shows that there is an increase in the transactions recorded by corporations in retail transactions to the final consumer. But also a recent paper by Brockmeyer and Mariba in Uruguay, where there is automatic exchange of tax rebates if you pay by card. And so this gives an incentive for consumers when they make transactions to ask for this receipt and to generate information that then can be used in what we know as third-party reporting. These schemes, what is their characteristic that is going to be different from, a little bit different from this scheme that I'm going to show today? They rely on active consumer participation, namely that the taxpayers, the final consumers, need to do something in order to ask for this receipt to be printed. For example, in the lotteries, most of the lotteries, they need to get the receipt and go in an online system and register it somehow. Parentheses, Greece is an exemption, and this paper that I have on the Greek tax lottery coming up, that this becomes automatic. But most of these schemes, even with the rebates, they need to do something. They need to actively participate in a way. And the general idea of these schemes is to generate economy-wide third-party information that can facilitate tax compliance even at the final consumer, and so close this VAT gap that exists in the final transaction. What's the difference in this scheme today? The difference is that the incentives, the third-party information, come directly through the income tax system. The research question in this respect is how effective are these incentives using features of the income tax system in changing behavior? And in this case, it's incentives to change the payments behavior of people from cash to electronic payments, so as to close the VAT gap in consumer transactions, in retail transactions. And this is the overarching theme. I mean, we know already that the incentives through the income tax system have been used widely. The earned income tax credit, for example, encourages work, and but don't know child benefits, for example, support families. But this is something else. It's an extension that goes beyond the usual incentives that governments give. They touch upon payments behavior, changing the payment behavior of people. Other advantages, well, they apply widely. They don't rely on the participation of individuals, on the big or medium size when you compare it to the economy participation, but it applies to the whole of the taxpayer population immediately once you vote for it and you implement it. And this is implemented relatively quickly, so it applies from the next year when the law comes in. And so the question becomes, how do taxpayers respond? When will you make it obligatory for them, in a way, to ask for receipts or to change their behavior in order to gain something? Let me be a little bit more specific about the scheme. What does it do? In 2010, when the economic crisis began in Greece, the governments looked for different ways to increase tax compliance. And one of the ways was to oblige individuals to collect a part of their income in paper receipts. So most people had shoeboxes, actually, that used to put paper receipts inside. And this used to be a percentage of income, like 10% of income. And in case you got audited, you needed to show these receipts, that you collected these receipts. Otherwise, you faced an extra tax. This policy changed drastically in 2017 when the Independent Authority for Public Revenue in Greece became independent, similar to the IRS in the US. And so they devised a strategy for electronic payments. And they changed this policy in 2017 to a requirement of individuals, instead of collecting paper receipts, in paying with electronic payments, namely bank cards or electronic transfers for everyday transactions, so as to gain a personal tax discount. And so this is the basic idea. Imagine that you are a wage earner, you are an individual that earns a wage or a pensioner, and the first 10,000 of your income are tax exempt. You receive this tax exemption, you don't pay tax on your first 10,000, only if you reach an amount of electronic payments every year. And so this makes it automatically individuals pay with electronic means, either cards or electronic transfers, so as to gain this personal tax allowance every year. Let me know if you have any questions by this point about the policy. Okay, I don't see any questions. So what is behind this system? In 2017, as the policy kicks in, there is an administrative system behind it that requires banks to report monthly on the aggregated volume of payments per taxpayer. You open a bank account, you declare your ID. When you fill in your tax returns, the tax authority requires you to have an IBAN, and they match this automatically. And so at the end of the year, the annual amount of payments that you have made with electronic payments is pre-filled in your tax returns. And as a taxpayer, you can, using self-assessment, you can confirm this amount, or you can report a different amount. And based on this, if you have reached the amount of payments that you need to reach, you get the tax discount that you are eligible for in the for the tax year. And so this is an example of how it looks like below here. I won't tell you from whom this comes from, but this is how it appears. It appears in your tax returns here as the annual amount of payments, and you can confirm this amount, or you can change it accordingly based on what you need to fill in. And then the next step is you get your tax bill almost immediately. What is the incentive? Well, it's a 22% discount. So for every euro that you spend in electronic payments, you get 22 cents back in a discount. But of course, there is a limit. Otherwise, taxpayers would spend forever, and they wouldn't. They would eliminate all their tax liability. And this limit is a threshold, basically, that is determined by the income of individuals and the rate that is set by the government. So up to this threshold, you can gain a tax discount by electronic payments. This is how to determine the threshold. It's a rate, 10% on the first 10,000, and this makes a threshold of eligible payments, 10% on the first 10, and then increases marginally on income, 15%, 20%, and up to 160,000. And let me give you just a quick example, just to know how to calculate this. Let's say you earn 10,000, then your threshold is 10%, and so it's 1,000 euros in electronic payments. So for the first 1,000 euros that you have to pay, you earn a tax discount of 22%, namely 220 euros in tax discount applies for this individual that declares 10,000 of income. So the threshold in a way is personal, and it's calculated based on the amount of payments. Let's say you earn 30,000, then for the first, your threshold is calculated as follows. For the first 10, it's a 10%, and then for the next 20, it's a 15%, and so it's a 4,000 of electronic payments that you need to reach to earn a tax discount. And this tax discount is 22%, namely 220 euros in a tax discount. This has been the main form of personal tax allowance in Greece, and since 2017, it's been directly connected to the electronic payments you make every year. And the second thing that I have to say about this is if you exceed this payment, if you exceed your threshold, you don't earn more. This is the maximum tax discount that you earn. So how do we think about this in economics terms? And this is a very simple model. This policy introduces a choice of individuals between electronic consumption and cash consumption. So they have a choice either to increase their consumption, the electronic consumption during the year and gain this tax discount, or alternatively, if there is a part missing, they can also report higher amounts as well. So they can increase their reported consumption, or they can increase during the financial year their electronic consumption. There are some costs of doing so, namely changing the behavior from cash payments. Most of the cash payments in Greece, most of the payments are made in cash in Greece, about 80% actually. And there are also some costs of reporting, which come mainly from the usual costs, expected costs in the literature of audit and penalties. And for the moment, we assume an exogenous income so that we don't have any labor supply choices. This is a basic way to think about this. We have a cash consumption and electronic consumption that increase directly the utility. We have Z at this utility from labor, but it's exogenous for the moment. And the costs of electronic consumption and the costs of reporting higher amounts in your tax returns. This is a usual budget constraint. The cash, the consumption that you have is equal to after-tax income, where tilde is any kind of income tax, normal income tax. And then this is the effect of the policy, the additional effect that the policy introduces. The F represents a threshold. There is a threshold for an individual that is based on income Z, and A, the exogenous set parameter by the government, which is equal to this marginal tax rate here. So these determine a threshold of payments for individuals that need to be reached. Basically, this extra tax applies to the individual based on the threshold and can be eliminated by two ways: either increase electronic consumption or report higher amounts during tax returns. And this is the effect of the policy. What are the predictions of this model? Well, it's pretty straightforward to see that the rational choice of the individual would be to eliminate this extra tax that is created by the threshold. And to eliminate this, they need either to increase consumption, electronic consumption, or to report the additional consumption missing in the tax returns. And so we have three predictions. That firstly, there will be threshold targeting. The threshold that they have based on their income, they will try to reach it. And secondly, they will either do it through the normal route, the electronic consumption route, or they will do it through higher reported amounts in tax returns. And so this is the three things that we will test. How are we going to do this? We have a random sample of 50,000 taxpayers from 2017 that have reported their income and consumption in 2018 for the financial year 2017. And we observe the following. We observe their monthly electronic consumption. And based on this, we can add them up for all the months in 2017, so as to determine their pre-filled consumption information in the tax return. We observe their declared income in tax returns, and this can be used to calculate their threshold. And we also observe what has been reported by the individuals in the electronic consumption. And by having what has been pre-filled and what has been reported, we can calculate the difference, what they have, they had to start with, and what they finally reported based on their threshold. So in a way, we have all elements in the model to make the assessment here of how these taxpayers report. And this is our first result. Sorry, let me guide you through. Here we observe two distributions. One is the pre-filled distribution, and the other is the reported distribution. It's based on, it's centered at the tax, at the threshold of individuals. So the 0 here marks that individuals report, they have pre-filled information exactly as their threshold is. So what they report as income, calculated as their threshold, they know exactly their threshold, and they target their electronic consumption so as to match the threshold here. And on the top distribution is what it's been reported after the pre-filled information. And here the 0 signifies that individuals report the amounts that corresponds exactly to what their threshold should be. First thing to observe, there is some evidence already of targeting using electronic consumption because there is visual excess mass on the pre-filled information. There is a significant mass, 27%, that does not reach this threshold using their electronic consumption. But when we see the reported information, this is quite different. So we see a clear cutoff, visual cutoff at the 0 mark, meaning that individuals report exactly what their threshold should be to gain the full tax discount. 84% reports more compared to 69 that used to be in the pre-filled information. And so the total of having reporting exactly on the threshold or above the threshold becomes around 92%. So this shows that individuals respond strongly to the policy. They know what the threshold is, and they report on or beyond the threshold to gain the full tax discount. The other thing, instead of the strong reporting that the policy implies, is also the difference between individuals that are below threshold in the pre-filled versus the reported, which is only 8% that stays below threshold when reporting takes place. We don't know the reason why there is 8% below, but for sure there is a shift from the pre-filled information to the report. So there is evidence of threshold targeting, both when individuals spend in electronic consumption and also when they report in electronic consumption. Can we do a little bit more? Well, we can assess the difference, the within individual difference of these two graphs. And so take what has been pre-filled and what has been reported per individual and assess the difference. And so the distribution here at the 0 acts as a measure of having both pre-filled and reported as the same value. And here we can see that about 36% of individuals leave the pre-filled unchanged. They don't change what has been pre-filled in their tax returns. And so they are more or less, let's say, truthful in what they have reported and what they have spent. What we see here in the right-hand side of the distribution is values that have been increased at the same time. So 48% increases their reported values. But what is most significant on this is that the increase takes place in multiples of 100. So there is a significant visual mass in the 300, 400, 500,000, for example, of this distribution, which signifies not that individuals increase it to correct small mistakes, but it's a deliberate buoyancy of multiples of 100. And so this is suggestive evidence of this happens to reach the threshold. Can we do a little bit more to identify who are the taxpayers that increase the amounts? It seems that we have some evidence. by splitting the sample into those that happen to be below threshold at the end of the year to those that were above threshold at the end of the year. And the responses at the multiples of 100 happened to the ones that were below. Individuals that ended up below the threshold end up increasing the reported amounts during tax returns in multiples of 100. And the same does not happen in above threshold individuals. There is some evidence of increasing, about 33%, but it is not the same responses. And of course, for the below threshold individuals, it happens to a significantly larger extent. 83% of individuals that were below threshold increased their reported amounts, and some of them in multiples of that. And so these are the first results. There is clear evidence of individuals when reporting, when coming to the tax returns, of increasing their reported amounts so as to gain the full tax discount. What about responses in the electronic consumption? Does the policy affect electronic consumption? And recall that the ultimate effect of the policy was to induce third-party reporting by affecting the consumption of individuals, inducing electronic consumption in the taxpayer population. Well, the empirical strategy here is to use the variation of individuals that reach their threshold in different months of the year, and use the end of year deadline as a cutoff to assess if, as the end of year deadline approaches, if these individuals that were below threshold, they slowly increase their electronic consumption. Just a warning here, the groups that the individuals belong are not experimentally varied. There is endogeneity in where individuals belong. Namely, it depends very much on the payments that they make in belonging in the particular groups. But the idea here is to use the end of year deadline to see if there was an increase as we reach close to the deadline, and assess the individuals, particularly at the end of the year, and if this would induce any kind of responses in the population. The specification is simple. I just used lags for the year, and we observe also 7 years in 2018. So we can assess what happens after the deadline as the new financial year begins. And also what happens during the year as they reach the deadline. And this would give a good sense of the evolution of electronic consumption throughout the year. The dependent variable here is parameterized by the income of individuals. So it is the percentage of income that the individuals spend every month, and this is a percentage of their declared income. This is the big picture. We start from February going down, and then August to the new year, to December is here. And the groups are separated based on when individuals have reached the threshold. So for example, here, 1,000 or so individuals reached the threshold in February, so early on. And this is a group that exhibits quite high a marginal propensity to consume by electronic payments. So from the second month of the year, they reach that threshold, and you can see that their consumption, electronic consumption, is quite high. The same happens in the rest of the months. We see here the responses of individuals reaching their threshold in March, in April, May, and so on. And so about half of the individuals reach the threshold by the time August comes. Financial year runs, by the way, from January until December. So about half of the individuals are okay until August. They reach the threshold, and most probably these individuals are not directly affected by the policy because they already have some spending by electronic means. Then there are the groups that reach their threshold consecutively in September, October, November, and December. And here we can see, especially in the November and December group, quite high responses. So these are groups that have 1 and 2 months respectively in reaching their threshold. So for example, in November, they have only 2 months, and we can see here that they exhibit very, very low electronic payments as a percentage of income. This is it's close to 0. And suddenly in November and in December, this percentage jumps to 13% and then to about 7%. And for December, there is an increase as well to 13% as a response of individuals to reach the threshold. This is strange because it does not match the seasonality in other groups. There is some kind of increase in the other groups as we come close to December, but not such a big jump. And also is very inconsistent to the previous behavior of individuals in the preceding months of the year, which the electronic payments are close to 0. So there is a very high jump in 1 or 2 months before the deadline. And then what we observe, the additional element is some evidence of electronic payments becoming entrenched in the new year. For example, here in the December group, they stabilize around 5% of consumption of annual income, and they stay like this in the new years, which might indicate that these individuals notice the policy very late. They increase their payments so as to reach the threshold. And then as the new year begins, to avoid the same pattern, after noticing the policy, they stabilize their consumption at a certain level of 5%. There is also the additional group of individuals that do not reach a threshold. And if you remember from before, these are the individuals that end up increasing their payments during tax filing, increasing their reported amounts. And for these individuals, the electronic consumption throughout the year is close to 0. And then as the new year begins, we see a small increase from 1% to about 3.6% by June in the new year. So there is a small effect as the new year begins for these individuals, but we see that during the year, at least the first year of introduction of the policy, the responses were close to 0, which caused them to not reach the threshold by the end of the year. And these are the individuals, as I said, that they, at the end of the year in the tax filing process, they increase their payment to gain the full tax system. These are the estimation results of the monthly event studies. You can see here the threshold not reached group that I last showed you. Very low payments, close to 0. A small increase here to 0.5% of income in the last month of the deadline to reach these payment amounts, and then a small increase with the new year to 3.5%, 3.6% by June. The February group, high payments, they reach that threshold pretty easily. They have a high propensity, and the responses in the the end of year groups, let's say in October, November, and December, you can see here the large increase in the December group of 12.5% compared to the rest of the year that they stayed low, below 1% and 1% of income in electronic payments. And the same here in November, 13% increase, and 7% increase. So a variety of responses. We have seen that there is a response when they do tax filing. There is a response in some of the groups when they need to change their consumption to reach the threshold. And so the question becomes, what explains this? And the paper offers an explanation through adjustment costs. It seems that a fitting explanation would be that these individuals notice the policy a little bit late. It is the very first year of introduction, and so it takes some time until the policy kicks in. And as they notice the policy, they slowly start increasing their electronic payments to reach a threshold. At the same time, liquidity constraints might play a role as well, because if they notice it very late, increasing the electronic payments by 12% in the final year, in the final month of the policy, might be very difficult for some individuals. And also for the group that remains below threshold, might also indicate perceived costs of audit being low for these individuals. So they might think, okay, it's very difficult for the tax authority to regulate all these people, check that they have reached this payment. So I won't change my behavior. I will just misreport at the end of the year. I will increase my report. We can define this a little bit more explicitly. If you remember before, in the model, we said that there are costs of increasing your reported income, and this will help us think about these adjustment costs and how they interact, and explain the variety of responses. So the costs can be defined as follows. They depend on the increase in reported amounts that you make. So if you increase your reported amounts, you face a penalty pi, and the probability of audit rho that are both below 1. And so the combination could be quite small, but perceived in the subjective sense of the individuals, the perceived audit probabilities could be quite low. And this is the marginal cost of misreporting. And we can define also some cost of changing the consumption behavior, which are based on the month, and policy inattention, theta, being very high in the year. If the policy inattention is, you have a high theta and a very high policy inattention, then the costs of electronic consumption are high, and so you prefer paying by cash. But as the months progress and you go closer to the deadline and you notice the policy, then theta drops and individuals are more inclined to pay by electronic means to meet the deadline, because the costs of changing the behavior are low. And the same with the liquidity constraints. So it might be the case that as if individuals notice the policy very late in the year, in the 11th month or 12th month of the financial year, they might face very high liquidity constraints in reaching the threshold, and this might keep them back from responding in the electronic consumption market. And this is a diagrammatical way to think about this. If the marginal costs are of reporting are higher, you might prefer to if the marginal costs of electronic consumption are higher, you might prefer to respond by reporting at the end of the year. And if the marginal costs of reporting are higher than electronic consumption, you might prefer to respond in the electronic consumption margin. The straight line here, the pi rho, it signifies the marginal cost of misreporting, which are fees of reporting higher amounts, which are fixed in all the months. And this is another possibility. If the marginal costs are significantly low, then individuals might prefer not to respond at all through the electronic consumption, and they might just prefer to increase their reported values during tax filing. And this would be the case that would signify that the audit strategy of the tax authority is not credible. At the same time, the y-axis is months here, so that could be the case where as we progress towards the deadline of the year and the policy becomes more noticeable by individuals, the cost of electronic consumption falls, and so they would prefer to respond more in the electronic consumption margin than change their reported amounts during filing. And that could also be the case where the individuals are liquidity constrained. Think about poor individuals that they don't use electronic consumption a lot. They have low payments, and so noticing it very late, they might have a high delta where 1 or 2 months of the year might be not enough for them to reach the threshold, and so this might also play a role in explaining the different responses that we observe. So in conclusion, this is a novel third-party reporting policy. It functions not through direct participation of taxpayers, but it makes almost all taxpayers in the economy eligible. And so it makes them actively engage in this policy to generate third-party information. It does so through the tax system. So it offers us an example where policies and third-party reporting in particular take place through the income tax instead of the consumption taxes. What we have seen from this policy is clear evidence of higher reported amounts to gain the full tax discount when these individuals report their amounts. There are a few implications of this. One, the fact that this is an unintended consequence of the policy. The policy was aiming to induce consumption behavior, and instead we see that there is some additional reporting, additional responses that take place that might have to do with tax evasion. And in addition to this, the significance of this result is the fact that the majority of these individuals are wage earners and pensioners. So it's normal to think that self-employed and business owners respond to this policy. Actually, they're exempt, but they respond to other opportunities in the tax system to evade. But it seems now that wage earners and pensioners as well, when they're given the opportunity in the institutional framework, they also take the opportunity, they use it, and they can respond accordingly, use these tax evasion opportunities. The second thing is effectiveness implications, because if, as we've seen, about 30% actually of the eligible sample is the sample that increases the reporting, then it has implications of the effectiveness of the policy. And the third thing that we observe is a variety of responses in the electronic consumption margin. Some individuals that reach the end of the year, there is suggestive evidence that they increase their electronic consumption. And there is some evidence also that this electronic consumption, at least for some of the individuals, becomes entrenched as we enter the new year. We cannot assess the full year, unfortunately, because that's how far the data goes. But there is some evidence of the electronic consumption stabilizing as 2018 comes in. And so maybe in the years that follow, it can be easier for these individuals to reach that threshold in time. Overall, we see a mixed policy outcome, and it seems that adjustment costs, namely policy inattention, the liquidity constraints, and perceived costs of audit in the tax administration's audit strategy regarding this policy might affect the policy outcome and the responses of individuals. And so this is the key takeaway, basically, of this policy. We can link many incentives to existing features of the income tax system. In this case, the changes in behavior from cash payments to electronic payments to generate third-party information. It seems that linking this triggers large responses, but the overall effect depends very much on the adjustment costs of in the taxpayer population. And at the same time, I think it also has an effect on, depends also on the structure of the incentives, the policy. And this is exactly an area where tax administrations have been quite inventive in the last few years in devising different policies to generate third-party reporting information. And with this, let me end here, and I will be happy to answer any questions or give your feedback. Thank you very much.
Thank you, Panayiotis. Very interesting paper and very interesting presentation, and quite topical as well. While please, if you have any questions, use the chat box, and or you can unmute if you want to ask the question directly. But let me kick off the discussion, if I may, Panayiotis. A couple of things I have noted down. One is the policy was enacted in 2017, which is the same year as the lottery. So the question is, are there any strange interplays between the lottery incentive and the tax incentive? Can you say something about that? Can you separate these? Can you disaggregate the effects? The other one is, I guess you alluded to it, and I guess you don't have the data, because the heterogeneity is going to be very important. And I guess 2017 is a fairly difficult year for Greece. I mean, not as difficult as the previous years, but certainly, 2017 is the year that is coming out of a huge recession. It's the beginning of coming out. And I guess heterogeneity, liquidity constraint is going to be important. And I wonder, you don't have that in the data. You can't really tease out to condition what you do on some measure of liquidity, individual taxpayers being liquidity constrained. Also, maybe you want condition on family status, just to see the profile of individuals, who spends what. I guess that would be interesting if the focus is on the adjustment costs. The other thing is, I guess, but I might be completely wrong. I guess you have 50,000 taxpayers, and I guess 49,999 are using tax preparers to do the taxes. I wonder whether there's any implication of that, whether tax preparers have something to do with the effectiveness of the policy. I guess your data suggests no, or possibly for the high income individuals it might be the case. So condition on that might be a good idea. And the fourth one, which is kind of peripheral to the other three, I guess what the policy does, it changes the bargaining between the sellers and the buyers. We know being Greek myself, sometimes in the past they used to bargain on the price, receipt no receipt, you get a discount. And I guess the policy, what the policy does, as with the lotteries, changes the bargaining nature of things. If you have any comments on that, that would be great. Thank you.
Yeah, let me answer it quickly. In regards to the lottery, yes, this was part of a strategy. There were other measures as well. The most important, I think, in 2017 was the lottery. The lottery was announced in September 2017. It kicks in slowly. There is a very big lottery that takes place in Christmas of 2017. Indeed, the only problem with convoluting factors is the fact that the data does not allow to have an exogenous variation of the consumption effect. So any variation of the groups is endogenous, but what gives out suggestive evidence that the consumption responses might be coming more from this policy instead of the tax lottery is the fact that there is an increase in these groups at the end of the year, which is not followed in the next few months. So as they start the new year, they go down to 5% of payments by electronic means. And so they don't seem to, the lottery starts and then goes on, but they don't seem to have the same amount of payments every month so as to participate more in the lottery. It just very, there is a direct increase as we reach the end of the year. But as I said again, there is no experimental variation in this so as to be very specific on identification, and I'm very clear on this. Then on heterogeneity, unfortunately, the data does not allow for this. We observe a few things here. I'm basing the analysis on single filing individuals. I have some information on joint filers, couples basically that they file jointly, but I don't have any information on their family structure. I exclude the joint filers from the analysis just because I observed the spending of only one individual, and there might be sharing of spending within the household that might complicate a lot the analysis. On the tax preparer as well, it used to be the case when there was the paper version of this policy, when they used to collect them in shoeboxes. Usually the usual way to do this for someone that hasn't collected any audited was to go to a tax preparer, and they used to have a shoebox of receipts for all the individuals because you couldn't check who made the payment. But in this instance, the payment is quite specific. So it goes from the individual. So it cannot be made by the tax preparer. Maybe the tax preparer can inform the individual about this policy, but the individuals need to make the payments. If they haven't made the payments, indeed, it might be the case that during tax filing, they tell them, I'm going to increase this for you. But of course, there is a risk. There is a risk that this, if you get audited. Although this is the clear evidence of the paper that it seems to happen, it is the individuals that are below threshold that end up reporting more during tax filing. Maybe it's coming from tax preparers, but I would expect that individuals need to know about this because this is quite illegal if it's an element of tax evasion. Changing the bargaining, indeed, yes. All these policies change the bargaining a little bit. I don't expect this policy to have had in 2017 a huge effect on the bargaining. Why? What is eligible in the payments, not big payments like cars or buying a boat to sail the Greek islands. all these are excluded. It's about everyday expenses that are included in the policy. But so is, supermarkets. So this would be the usual place for someone to pay by electronic means. And so it wouldn't be in a market that is very conducive to evasion, such as plumbers, for example, or car mechanics. These limits were increased, I think, a 1 or 2 years ago, but they have been suspended in the pandemic to 30%. So in the majority of individuals, it's around 10 to 15% of the threshold, but now it has shifted to 30%. So 30% of income needs to be paid by electronic means to be eligible for this tax discount. And there, the 30%, I expect that it would have significant bargaining, because it shifts the costs from either the evading firms to the individuals that need to pay, have an extra tax at the end of the year if they don't make the threshold. And so it would be interesting, in the future, if there is more data on this, although everyone knows how hard it is to get data, to see what the bargaining effect would be when this policy increased to a very high 30% of disposable income needed to be spent on electronic payments.
Thank you. Can I just quickly go back to the tax preparers, because I think it's quite interesting. I appreciate the fact that the tax preparer sees the amount of the tax return at the very last minute. Yeah. So when they do the self-assessment, they log into the system, they see the number, and I guess this is where the tax preparer might be advising, the taxpayer. And this is where the discussion might be taking whether to leave the number as is or shift it. So I think conditional on the tax preparers might give you a little bit more info, because what it does, tax preparer, what it does is it updates the probability of being audited for the taxpayer, and that changes the nature of the response. So if you can tease out that, I think that might be something interesting, if you see what I mean.
Yeah, that would be very interesting. Unfortunately, there is no information. The only thing that I have is a postcode and something, linking tax preparers that are close to individuals, because sometimes but this is not necessarily the case that they would go to the closer one.
Oh, I thought in the tax assessment, there was a box that you had to put the ID of the tax preparer, but that's not the case in 2017.
I don't have information on that. Yes.
Okay, I thought you did. Okay, thank you. I see a couple of. Do you see the chat box?
Yeah. I can answer quickly. Do we know the percentage of taxers we used to pay online before the policy? No, we don't. Unfortunately, the data starts from January 2017, the day that the policy starts. And so I don't observe what happens before. And actually, it would be impossible, because it's from January 17 that banks started transferring monthly data of individuals to the tax authority. So it's from that point onwards that we know what happens. It was zero beforehand. No, I assume there was still electronic payments, especially since capital controls kicked in 2017. There are a few payments that show that the card payments slowly increased. So there is an increasing trend slowly of electronic payments regardless of the policy. Is there any evidence that the Greek tax authorities were able to collect more revenue based on this policy? Unfortunately, I can only assess the consumers, the taxpayers' responses to this policy, but I don't have information. There is no way to assess the effectiveness of the policy in terms of tax revenue. I don't have a dependent variable on that, unfortunately. Actually, this is a side project from another paper, which is on the tax lottery, and there I do have an identification strategy. So this is a side paper out of that paper. It was not the intention of this paper to be the main paper, let's say. And so the research design was different. It was not so as to assess the tax revenue. But while doing so, it was clear that there were some responses from this policy that I could assess in another paper.
Thank you. Any other questions? Right. I don't see anything else coming through, but also it's 3 o'clock here in the UK. Let us say a big thank you to Panayiotis for a wonderful presentation and a very interesting paper. Thank you for joining us. I hope to see you soon.
Thank you. It was a pleasure.
All the best.
Thanks a lot.
Panayiotis, can you stay on the line?
Yeah, sure.
I had it. I'm using my iPad because my computer has been playing up, and I pressed a button, and I was the camera was looking the other way. Bloody hell! It's been recorded. It's been recording. So let me switch off the. Apologies for this, Panayiotis. I didn't notice.
Shall I stop recording? It's still on.
If you can.